In a dramatic realignment of worldwide energy pathways, China's imports of U.S. crude oil have dropped by almost half, reflecting not only the nation's shifting energy preferences, but also the wider rearrangement of global oil markets. According to fresh data from Kepler, China took in merely 81.9 million barrels of U.S. crude in 2024, compared to 150.6 million the year before, a 46% plunge. Consequently, China has slipped from being the second biggest American oil buyer to the sixth largest. Below are the critical catalysts behind this substantial downturn and the ripple effects for the global oil landscape. The shift in China's oil import strategy. China, noted as both the largest oil importer and second largest oil consumer worldwide, has historically secured crude from a diverse range of suppliers to fuel its extensive energy requirements. However, recent reports indicate China's aggregate crude imports decreased by around 7.2% year-over-year, an outcome tied partly to periodic COVID-19 lockdowns, ample domestic inventories, and planned refinery overhauls. Despite this drop, China has recalibrated its purchasing methods, seeking to obtain oil under more favorable or flexible conditions. Official customs data point to a calculated move away from certain Western producers, underscoring Beijing's multifaceted approach to sourcing cheaper oil and fortifying its energy security plan. The rise of discounted crude supplies. Recent Kepler figures show that the share of China's ocean-borne oil arriving from Russia, Iran, and Venezuela climbed from 24% to roughly 26%. Though that fraction may seem slight, it represents a substantial boost in absolute volumes against China's massive import base, which can exceed 10 million barrels daily. Russia has been granting steep markdowns on its Urals crude, compelled by Western sanctions, making it appealing to Chinese refiners pursuing lower input costs. Iran, also under U.S. sanctions, keeps shipping crude to China by employing strategies intended to mask its origin. Tactics like shutting off transponders or performing ship-to-ship transfers near Malaysia or the Persian Gulf. Venezuela, heavily restricted by U.S. sanctions, continues exports under intricate payment conditions and third-party mediators, but the bargain pricing remains enticing for China's thrifty teapot refineries. Taken together, these cheaper sources have replaced part of the void left by fading Western shipments, while further entrenching China's engagements with diplomatically marginalized oil suppliers. Key drivers behind the realignment. The gravitation towards sanctioned or heavily discounted exporters arises from a fusion of financial and political motivations. On the economic side, Chinese refiners benefit from favorable profit margins by buying crude at rates markedly under global benchmarks. These savings can be allocated either to subsidize domestic pump prices or to bolster refined product exports, notably within Asia. Concurrently, broadening supplier options enhances China's energy security by lessening its reliance on any single source, thereby limiting vulnerability to political upheavals. Another motivating factor is the chance to expand diplomatic and trade relationships with nations like Russia, Iran, and Venezuela, which are eager for new customers to counterbalance Western sanctions. This stance strengthens China's role as a global power prepared to act outside the sphere of U.S.-centered policies. Tracking and trade dynamics. The circulation of sanctioned crude to China can be intricate. Analysts at Kepler, Vortexa, and similar organizations deploy satellite images, AIS data, and port records to follow ship movements. These findings uncover methods such as turning off AIS transmitters and performing ship-to-ship loading, often near Malaysia's coastline, to hide the real source of shipments.